Let's welcome on board Jairam Sridharan, the MD and CEO at Piramal Finance, joining in on the show right now. Jairam, hi, morning. Great to have you on the show. You've reiterated this 25% AUM growth despite a softer mortgage environment. Tell me which businesses will contribute the incremental growth over the next 3 years, or rather 3 quarters. Would it be mortgages? Would it be unsecured, gold loans, or wholesale?
Thank you, Aisha, for having me on your show. It has been, yes, a strong quarter so far in terms of growth. And yes, we have reiterated our guidance at the beginning of the year that we will be growing at 25% through the year. If you look at the product split, it is more likely to come from the unsecured side and from the loan against property side. Those are businesses that are growing the fastest. And I expect them to continue to drive the business growth. We are also investing in a couple of new businesses, which we have not had in the past, which is around rural lending and around gold loans. These are very new businesses for us, but hopefully they will start contributing, not in the next 3 quarters, but maybe in the year after. So those are going to be the big engines of growth. Right now, small ticket housing loans are the one area where there is softness in terms of demand. Otherwise, most of the segments we are seeing a lot of demand and a lot of strength in the underlying market.
Interesting. You've been guiding for a 50% PAT growth versus 25% AUM growth. Beyond the operating leverage, tell me, what are the biggest drivers? Is it going to be lower funding costs, better mix, lower credit costs, or leverage?
Yeah, no, you've touched on all the important things, Aisha, but let me just give you a sense of the pecking order there. The most important for us is going to be the improving operating efficiency. So we have shown our OPEX to assets ratio reduced by about 300 basis points over the last 3 years. We expect another 50, 60 basis points to come from there. So that's going to be it's consistent with what we have said in the past, and it continues to be the number one driver for us in terms of continuing to improve our profitability profile. The second big element is cost of funds, as you rightly mentioned. Earlier in this calendar year, our company got upgraded in terms of credit rating from a AA to a AA plus credit rating. So that I expect should over time contribute 50 to 80 basis points of improvement in our cost of borrowing as our current debt rolls over. So those are the two biggest items that you're going to see. There's also going to be a little bit of mix shift towards unsecured, which should be profit accretive as well. So those are the main areas from where I expect to see profit improvement.
Jairam, interesting, you spoke about that you're entering into 2 key markets, which is agri lending and gold. And agri at a point when you have, there could be a stress coming in because of the El Nino and monsoon impact, which is there. And gold, the market is tapering off with respect to the gold value there. What kind of opportunity that you see and what kind of investments that you will have to make there?
Right. So there are kind of 2 questions embedded in what you're asking. One is kind of the cyclicality of the business and the fact that cyclically it might appear that these businesses might have some challenges ahead. Gold in terms of commodity price reducing, or agri in terms of what's happening to the monsoon. And those are absolutely valid concerns, and it's the right question to ask. However, as operators who want to be in business for decades, not for quarters or years, we have to worry a lot more about the underlying structural demand situation rather than the current kind of point in the cycle. As you, I'm sure, tell your viewers about investing, it's very hard to be super right about where you are in the market. But as long as kind of you're in it for the long run, you will be okay, irrespective of when you enter. It's kind of like that in building businesses as well. So that's why we continue to build, even though the challenges that you pointed out from a short-term cyclicality standpoint are absolutely valid. So both on the gold and in rural, we will continue to invest. Our intent is through this year, I hope to open about 200 branches in gold And by the time the year ends, we'll probably have about 250 odd branches in rural as well. So this is the main area where we are actually spending a lot of new branches. We are not opening that many branches in our urban markets right now, but it's in this rural and gold formats that we are really expanding our coverage of the country.
Another segment is the unsecured portfolio. We've seen that risk coming in the last 2 years. Has it abated fully now? And what kind of growth that you see, given the fact that you have grown around 45% year on year on that?
Yeah, the unsecured business risk peaked in calendar year 24, right? November, December calendar year 24 was kind of when the risk was at its top. Since then, it has slowly moderated. Right now, unsecured is a broad business. There are many components to unsecured, but some of the main components are right now actually at 3-4 year lows in terms of where risk is. So risk has really moderated in that segment. And but remember that this is a cyclical business, so risk will keep going up and down. So right now it's on the down part of the cycle, and hence kind of unsecured lending will make right now a lot of money. But there will also come up parts of the cycle when it will not make as much money, or might even lose at some point. But right now it's a really good time. The way we are seeing it, the demand is strong, and risk performance looks pretty good as well.
And, Jairam, also trying to understand how should one look at the credit cost number? Because you've seen a bit of an inch up in the credit cost this quarter. How should one look at what's the target like? What's the full year guidance like? What's played out? Give us some color on that.
Yeah. So, see, Q1, we had a credit cost of about 1.6% versus a 1.5% in Q4. This is very normal. It's fairly flat. No, first quarter is always going to be a little bit higher in terms of credit costs, because Q4 performance is so strong that most customers who are on the edge have been held back in Q4, and some of them kind of end up flowing through in Q1. But really, 10 basis point delta is perfectly fine. I'll take it any day of the week. So 1.6%, fairly stable credit cost. It will continue to be stable for the next couple of quarters at least. That's what the early risk data is showing us. Early risk is not showing any increase, and it's a bit surprising given what has been happening in the West Asia situation, what we are anticipating because of the El Nino effect, etc. So there is enough macro noise that makes you worry that there is going to be a problem in asset quality. However, when we are looking at the actual data, when we are actually looking at customer performance, we are not seeing any of that deterioration. We are not seeing any of that anxiety. So it's been a bit surprising how good asset quality has been in the first quarter of this financial year.
Heartening to hear. Jairam, thank you so much for coming in and speaking to us post the numbers.